Neo Performance Materials decisively beat Q2 consensus across the board. Revenue hit $205.75 million, which completely crushed the $170.58 million estimate. Adjusted EPS came in at 51 cents, beating the $1.46 estimate, and they also reaffirmed a raised full-year adjusted EBITDA guidance of $140 million to $150 million.
Right, and yet, despite all of that, a massive double beat and a record $57 million in adjusted EBITDA, the stock just immediately plunged over 11% post-earnings.
Yeah, imagine crushing your quarterly estimates, posting record profits, and then just watching your stock plummet. So that is exactly the paradox we're looking at today. We're taking a deep dive into Neo's earnings report, management's commentary, and those underlying rare earth markets to figure out why Wall Street is punishing what looks like a perfect quarter and what this actually means for your portfolio.
Yeah, it's wild. And honestly, when you look at the segment breakdown, that initial reaction makes even less sense. The rare metals division was just an absolute standout here.
Oh yeah, totally.
Right. They posted $106 million in revenue and this massive, 300% year-over-year EBITDA spike. And then you have Magnequench and the chemicals and oxides divisions also showing really solid, consistent growth.
Wait, the 300% spike in one segment? That sounds like a total one-off anomaly. Is that just, management spinning a lucky quarter, or is there an actual structural reason behind that jump?
No, it's a real structural reason. It's heavily tied to this incredibly tight global supply in three very specific metals. So we're talking about hafnium, gallium, and tantalum.
Got it.
Because Neo has secured access to these materials, while the broader market is basically starving for them, they're commanding a massive premium right now. But honestly, the real driver of that EBITDA jump isn't even just the pricing power.
It's the internal efficiency, right?
Exactly. Over the past 2 years, Neo has managed to drop its conversion costs by 20%.
Yeah, that metric really stood out to me. And for anyone tracking industrial margins, a 20% drop in conversion costs is huge. It's sort of like a commercial bakery. Figuring out how to bake, twice as many loaves of bread using the exact same amount of electricity and flour.
That's a really good way to put it.
The revenue scales up, but the cost to produce each unit just plummets, so you get this pure, compounded profit margin expansion.
Right, which brings us to the core tension of this whole report. Because if operations are humming that efficiently, Wall Street's panic just doesn't add up unless, investors see a cliff ahead.
The guidance cliff, yeah, management essentially got on the call and told everyone not to get used to these numbers.
Yeah, they did. Their Q3 and Q4 guidance assumes basically minimal spot sales. And spot sales are those high-margin, immediate delivery orders that drove so much of this quarter's beat.
So they're worried about demand pull forward then.
Exactly. After such a massive first half, management took this very conservative tone, and that sparked fears of demand pull forward. Investors are looking at this wondering if customers just front-loaded their annual orders to secure supply early.
Which means the second half of the year could just be flat.
Right. Add in some profit-taking near 52-week highs, and boom, you get an 11% sell-off.
Yeah, but there's another layer to this sell-off too, and it's tied to their European permanent magnet facility. Phase 1B is aggressively targeting 5,000 tons of capacity.
Yeah, and the standard narrative there is that scaling operations exposes them to some heavy execution risk, combined with their pricing dependence on these volatile rare earth markets that are heavily influenced by China.
Sure, but I'm actually going to push back on that risk narrative a bit. Are strict Chinese export controls actually acting as a protective moat for Neo's new European operations, rather than just, a supply chain headache?
Well, management basically confirmed that dynamic on the call. Those Chinese export controls restrict the outflow of processing technology and equipment. And that makes it significantly harder for Chinese suppliers to physically build and expand their own manufacturing footprint inside Europe. So while it does complicate global sourcing, it simultaneously shields Neo's localized European production from having direct Chinese competitors just setting up shop next door.
Wow, so it's a localized monopoly taking shape.
Pretty much, yeah.
It completely flips the geopolitical risk argument on its head. Now, before we wrap up this deep dive, I want to leave you with one unpriced variable to add to your own notes. Beyond the standard EV narrative, Neo happens to be the largest producer of bonded magnetic powders outside of China.
Oh, right, which are critical for complex precision motors.
Exactly. Think about emerging tech like humanoid robots. A single humanoid robot requires anywhere from 3 to 7 kilograms of these magnets.
That's a lot.
Yeah, and you add in the exponential growth of commercial drones, and you're looking at a massive structural demand shock for bonded magnets in the coming years. What happens to a highly efficient producer like NEO when that technology fully scales?
Yeah, it's a huge long-term catalyst entirely masked by short-term spot market volatility.
Exactly. Keep an eye on it and make sure you follow the show for our daily earnings coverage so you don't miss deep dives just like this one.